How's it going, YouTube? Welcome back to another video with the House Money Investing channel. Today's video will be going over 10 stock ideas for quarter one of 2021, as well as a couple of bonus stocks for you guys, some price gains I had today, as well as some price movements. So jumping right into it, the first stock we got here, we're going to go over a couple bonus stocks before we get into the 10 plays for this quarter. This is going to be ticker BAND, BAN. This is a bandwidth. This stock here was down about, almost 20% during the pandemic. Still finished the year out above 143%. So a nice, real nice growth play. This is a new IPO back in 2017. And it's, on average, well over 100% gains per year. So great growth play here. It's not a dividend payer, but like I said, it's ran up this year itself from $50 all the way up to $198. It's currently at $157, so you still got a lot of room to run back up about $41 up to that all-time high to test that resistance. $4 billion market cap. Looking at non-analyst ratings, they got it at an 89% buy and a 0% sell. BAN has killed earnings throughout 2019 and 2020, and this is a telecom software company out of North Carolina. And what it does is it provides cloud-based communication services. It offers data internet, voice over internet protocol, messaging, manages networks and conferencing services. The firm basically serves the telecom needs of small and medium businesses. So this is a nice play into that cloud-based network that is really popping off. And as you can see from this play, it's really done well for these guys. So this is something I'm gonna jump into and swing trade into a position. The next ticker we have here is Aaxn. This is another bonus stock. This is gonna be the last bonus stock. This thing here was beaten down during the pandemic as well, about 20-30%. Finished the year out above 60%. And this is another play that's been gaining over 100% per year on average. Once again, a growth stock, not a dividend payer. Great market cap of $8 billion. It came from $50 to $134 in the past year. It's about $13 off its all-time highs. Looking at 13 analyst ratings, you got a 62% buy rating, 38% hold. EPS has been hit or miss. Quarter four is a little suspect, but quarter one 2021, they're expected to have a great EPS. This is an industrial company out of Arizona. So to give you a nice exposure to the business and industrial sector to the in the market. And what this place basically does is they making electrical weapons for personal defense. They do developing, manufacturing, and sales, and they make tasers, softwares, different kind of sensors and accessories, and they also have related products and services in that realm. So a nice defense play here. It's kind of unique. That's why I caught my eye. Great self-defense tool is a laser. So hey, this company's done great. Obviously their fundamentals are pretty good. The balance sheets are looking good. So definitely something I'm gonna jump into. Next here, we have the Acorns account. My current value in the Acorns account is a little over $1,100, and I'm currently up 3%, 3.15%. Total gain is $185 over the last 6 months. 3% isn't, it's only doing about a third as good as the market does. But in this Acorns account, what I do every 2 months is change my risk tolerance, down from conservative all the way to aggressive. So I'll start out in bonds and treasuries and steadily work my way up toward those blue chips. That's why you don't see a massive gain. But it is something that I'm doing consistently, and it's something that it's just a play for me to be able to get, that drip going for the dividends, as well as being able to secure my position financially without losing any capital or any principal. Next here we have Stash. This is my IRA account. I've only deposited $255 in this account last year, but it is up a nice percentage, 38.30%. Total gain is $97.67, and my top holding is Upwork Inc. It is 8% of my portfolio, and it is up 115.50%. So nice gains from Upwork. Overall, nice gains for the smaller IRA portfolio. And this is what you all been waiting for, the 10 stock ideas for Q1 2021. The first company we're going to look at here is ticker HXL. This thing has been beaten down massively. During the pandemic, it was down about 60%. You still have about a 34% run up for this company. Since their IPO date, even with this year, being a very, very poor year, they're still up over the past 5 years, and it's been making a comeback for the past 3 months. It's recovered about half of its position, and it still has another half to go. So like I said, it's going to run up another 35% here in 2020. Decent PE ratio, does pay a small dividend of 0.70. It's kind of more of a growth play, and it is $34 off of its 52-week highs. Looking at 20 analyst ratings, you got a 55% hold, 25% buy. EPS hasn't done so great. We're expected to have a bounce back in Q4 2020 when those EPS ratings come out, as well as in 2021. And this is to give you exposure to the sectors of industrials and materials. This is a company out of Connecticut, and they develop, manufacture, and market composite materials for commercial, aerospace, space, and defense industrial markets. So basically they have certain materials which are going to be like fiber reinforced matrix materials, honeycomb core product lines, and stuff like that. Some very advanced stuff, dealing with the aerospace, space, and defense sector of the market. And as anybody knows, aerospace has been really beaten down this year with everything locked down. Not a lot of free cash flow going out. But 2021 is a bounce back year. So definitely going to see a lot more growth left in this company. Stock number 2 we got. Take out IRM, Iron Mountain. This is a play that I already own long term. Something I swing trade quite often. This one also had a poor year, down about 30% during the pandemic. Still has about 5% growth left, in this company. And it typically grows, about 2% a year. But this year was not the year due to the pandemic. But here in 2021, I expect to see about a 5 to 6% growth here in Iron Mountain. Iron Mountain is a great play for this year, not only because it's going to grow, a little bit, 5 or 6%, but you're also going to get a nice dividend yield of 8.39%. So add those two together, you'll probably see about a total return of 14% on your investment. 7 analyst ratings, 71.4%. Got it as a buy. Iron Mountain operates, a highly durable business model with consistent cash flows, and with new opportunities in areas like data centers, that's going to provide more attractive growth runway. And they also, they boast an attractive dividend yield, like I said, about 8-9%, and it's, relative to other REITs. Their EPS has been down. They had a good Q3, but their Q4 of 19 was down. I'm sorry, but 2020 they actually been up on EPS. I just say down because it's not that big of a growth. It's like 0.11, 0.34 cent. And this is a business out of Massachusetts. It engages in the provision of storage and information management solutions. And it has a few segments that it operates in, like North America. They have a management business section, data business management section. They also operate in Western Europe and other international companies as well, even in Canada. But they basically handle and protect data for data recovery, servers, computers, backup systems, safeguarding of electric and physical media in the in these different countries and such. They also have document management solutions, which they operate through United Kingdom, Ireland, Australia, Belgium, France, Germany, Netherlands, Spain, and Switzerland. So a nice play, in the data space. And like I said, it's something I hold long term, something I've been swing trading. I'm going to add it back to the watch list here and give it another go as I see this growth with the nice dividend payout for 2020. Next up, we got ticker C. This is Citigroup. This is something I hold long term. I'm currently up 84.64%. This is a play I got back in around August. I have collected dividends in November, which was nice because they got reinvested with the drip feature. But like I said, I'm up over 84% on Citigroup, and that was even with the bad year that it's had. It was beat down to like 70%. It's making a comeback, and I see it's still about a 16-17% growth for 2021, which will put me over 100% in the positive. They're going to pay a nice dividend yield of 3.90, right in that sweet spot of 2 to 4%. 10 analyst ratings, 40% hold. I'm sorry, 40% buy, 60% hold, 0% sell. Their EPS made a comeback here in quarter 3 of 2020, and quarter 4 should be a nice bounce back as well. And basically what Citigroup is a financial holding company. It provides financing, leasing, and advertisement, like they give advice and stuff like that. They have commercial banking, consumer banking, and corporate banking. They have commercial financing, real estate financing, business capital. It provides a range of lending, leasing, deposit products, stuff like that. They also do cash management. Primarily, they operate with like small or medium-sized companies. They also do mortgages. They do a whole bunch of stuff, in the financial sector. So this is a nice bank. Me personally, I love Citigroup. I do, use their products and things of that such. I do have a line of credit with Citigroup, or Citigroup, I'm sorry. And the next ticker we're going to look at, stock number 4, ticker FL, Foot Locker. This is something I hold long term, something I'm going to continue to swing trade. Foot Locker was beat down over the pandemic nearly 50%. It recovered, still finished atop of the year up above 6%. This thing is, poised to come back, as it shows, they kind of got their fundamentals together, after having this rough year, because this thing has been beaten down for quite a while. So it's looking like it's on the up and up now at the end of the year with a nice recovery, making a nice strong recovery. Foot Locker does pay a nice dividend, 2.30%. 23 analysts, 43% buy, 52% hold. Great EPS in quarter 2 and 3. Of course, quarter 1 was down, but 2 and 3 was great. And it's probably due to the e-commerce, a lot of people ordering online, and they basically retail like athletic shoes and apparel. Foot Locker is a great company. I do buy products from Foot Locker quite often. I buy a lot of Nike products, LeBron shoes, things of that such. So I'm definitely liking Foot Locker. It looks like they got their stuff together after this pandemic, and we'll see how it performs next year. Next, we have a new play for myself. This is Kansas City Southern Inc., ticker KSU. They were also beaten down about 30% during the pandemic. Finished the year out up 32%. They finished the year out up 32%, and this company typically grows about 30% a year. They have a nice PE ratio, nice balance sheets, does pay a small dividend of 0.80%, 95% hold rating for analysts, and basically KCS, they're building a material intermodal franchise with which they have access to Mexican ports and an exclusive bridge at the U.S.-Mexican border crossing, in Laredo. So basically, they're placed to carry containers, from Mexico to the U.S. And their operating ratio is vastly improving from just a few years ago. It's now roughly on par, with the industrial average that's in the sector. The pandemic disrupted their Mexican plug out there, of course, but they're expected to continue to capitalize on growth opportunities sparked by Mexican energy reform, particularly refined products heading into the country. EPS was great in Q3, and like I said, this is an industrial company out of Missouri. It's going to give you exposure to the transportation and construction services of the market. And this is a transporting holding company. It focuses on growing north or south freight carrier connecting key commercial and industrial markets in the United States with major industrial cities in Mexico. The company also engages in the freight rail transportation business, operating through a single coordinated rail network. So a nice play into the logistics space through railroads and stuff like that. And they're basically transporting freight back and forth from U.S. and Mexico. And if you don't know, we exchange a lot of goods between us and Mexico. And they have the containers which come on the trains, and they're put onto trailers and hauled around by 18-wheelers. So definitely a nice play there. A lot of growth, and with that unique pipeline, I see them continue making money. Next here we have OYX. This is a play I do like. It's a petroleum company. I'm not personally adding it to my watch list just yet, due to the fact that it's been beaten down so much over the year. But it does have great potential to make a bounce back of about 50%, 55%. The only reason I'm not getting into it, because looking at the technical analyst, it's got to break that resistance for me to actually, be 100% sure, or nearly 100% sure that's going to make that run back this year. Just because this particular company has been beaten down pretty badly, over the past two years. I mean, 2021 could be its year. It's looking like it. There's a wedge formed. If it breaks out of that wedge, if it makes an upward trend, I'm going to jump in. If it makes a downward trend, then I'm going to leave it alone. So I'm just going to keep an eye on this one. It also does pay a nice dividend of 4.74%. So you'll get a nice dividend plus huge growth, if it breaks out of that triangle. If not, then I wouldn't touch it. We got a 23% buy rating on it, 58% hold. The low carbon venture segment is synergized with Oxy's chemical business, and Oxy's EOR portfolio holdings and expense give it a natural advantage in carbon capture. Oxy has a dominant position in its business. It has one of the cheapest sources of production in the U.S., and it's expected to have a major growth engine within the next few years. Oxygen generates much more cash than it spends, which means once the balance sheet has been patched up, it can restore its industry-leading payouts to shareholders. So basically, the cash flow is starting to look good, and we're still waiting on that balance sheet to get right. EPS hasn't been so great as well, but this is an energy company out of Texas, give you exposure to the material sectors, and they basically engage in the exploration and production of oil and natural gases. The oil and natural gases segment, explores, develops, and produces oil and natural gas liquids, natural gases, stuff like that. Their chemical segment manufactures and markets basic chemicals and vinyls. They also have a midstream marketing segment that deals with transportations and storing the oil, as well as carbon dioxide and things of that nature. This company has been out since 1920. I'm just waiting for that cash flow to take over the balance sheets to get it in the positive, and waiting for that upward trend to make my move into OXY. But definitely something I'll keep an eye on. Maybe something I swing trade in February or March, depending on these circumstances. Next here we got Raytheon Technologies, ticker RTX. This is a long-term play for me. I'm currently up 6.43%. This is something I always swing trade periodically, and I'm going to swing trade this again. Raytheon was beaten down about 50% during the pandemic. They are slowly for surely consolidating, making a little bit of comeback at a time. I expect about 23% growth here in 2021 for Raytheon. On average, they grow at about 4% a year, but this year will be unique because it is going to be a bounce back play from last year's lows. And Raytheon also pays a solid dividend, a little bit over 3%. And it's got 75% buy ratings from 20 analysts. So a nice analyst rating. They're basically, Raytheon's a defense company. They make missiles, and they basically do national defense strategy, which I believe is going to lead to that consistent growth. And they're also balanced between commercial aerospace and defense as well. So a nice play into the industrial segment, into the defense segment, and the aerotech industry. And I actually just received a dividend for this company back on December 17th. And like I said, they do aerospace, defense systems for the military. They also do it for the commercial units, and they do it for the government. They specialize in aerostructures, avionics, interiors, mechanical systems, mission systems, and power controls. They also design and manufacture aircraft engines, auxiliary power systems for the commercial, military, and government aircraft. And they also have an intelligent and space segment that involves in building sensors. They do trainings, and they do cyber and software solutions. So Raytheon is definitely a nice play into that space. So definitely something I'm going to continue to swing trade, as I do hold it long term. Okay, so the seventh one we have here is a new play for me. This is going to be ticker NOW, Servicenow. This didn't really get affected too much by the pandemic. It was only down about 10%, up 85% on the year. This one has shown massive growth, typically about 100% a year. So this is a nice play to double your money. Great growth stock, 34 analyst ratings, 76% buy. And in my opinion, their superior product is what has led to their rapid share, their rapid gains in shares. Exceptional retention with the ITSM market. Now the company is using the street to expand into other areas of ITOM. The company has added additional growth drivers, including customer service and HR service delivery, which should help propel the growth over the next 5 years. GAAP operating margin was break even for the first time in 2019, and we see a decade-long runway for expansion. Earnings has been great since Q4 2019. It's a software company out of California. They do cloud computing solutions. It offers customers and facility service management, service mapping, cloud and portfolio managing, edge encryption, performance analytics, virtual task boards, configuration management databases. So another play into that cloud computing system. And this company is growing crazy, as that whole sector is growing crazy. and this is a nice 5-year play. So it's definitely something I'm gonna get into. Try to get some shares up out of my swing and build something long term. Play number 9 is Trp Tapestry. Also beaten down about 50% over the pandemic. Still finished the year up 20%. This thing has not done very well over the past 5 years, but you know, after the pandemic, they kind of got their stuff together, and you know, the e-commerce really put them back in a position, you know, for good growth. And this is a Chinese company. You know, it estimates that the consumers will compose 40% of worldwide luxury goods spending up until 2025, you know, and it was up 33% in 2018. Tapestry just recently unveiled a new strategy plan in August of 2020 called the Acceleration Program to reduce operating expenses by 10%, enhance e-commerce, and close low-performing stores. Coach is one of the shares leaders in the profitable category of handbags and other goods. Coach bags are better pricing than many others, you know, allowing their growth margins to be around 50%. So Tapestry is basically an apparel company out of New York, and they hold some of the some well-named brands, and Coach is one of those brands. If you're into fashion or handbags or anything like that, we all know Coach isn't really, you know, something that people really want anymore so much. But there is a niche crowd that do want these products, and they do own a lot more brands than Coach. That's just, you know, something well known, prime example that I used. They do have other brands. I'm trying to think. So they have like Coach, Kate Spade, and Stuart Wiseman are the 3 brands that I'm really familiar with that come from this company. But basically they do luxury accessories and lifestyle brands, and they also sell their products global. They have operating stores. You know, you'll see like a Coach store or Kate Spade store at like the at the outlet malls and stuff like that. They also have internet, like e-commerce sales and stuff like that. They also have third-party distributors, like maybe, you know, like, I don't know exactly if it's Ross, but companies like stores like Ross and stuff like that that can also sell their products. So Tapestry, with the revise of its balance sheet and the e-commerce sector coming up, I see a bounce back here in 2021 for this play. So definitely something I'm gonna get into while collecting that dividend. And I'm actually a long-term holder of Tapestry. Another long-term play that I have is T-Mobile, ticker TMS. T-Mobile really wasn't affected by the pandemic at all. They ran through this year up 68%. This company typically, you know, grows about 40% a year. I'm currently up in my position 1.68%. It's a non-dividend payer. But T-Mobile's, you know, they're steady expanding. They just bought Sprint. They got Metro. They're buying, you know, a bunch of wireless assets from South Dakota. It's got a strong 81% buy rating by analysts. They're also coming out with the 5G, you know, expanding the networks. They have free cash flow that should be positive during the Sprint integration, and it should help them grow their capital as well. So definitely good EPS, of course. Telecom company out of Washington. And I actually do, you know, own some T-Mobile and Sprint. You know, I got a T-Mobile phone and a Sprint iPad, so I do use their services currently. And the reason why I went to these guys is because it's instant credit approval. You get your products right then and there. They have great payment plans, and they offer a whole bunch of incentives, like changing your phone number, you get money. If you put down a referral, you and that referral get money. They always giving out, you know, pretty good discounts. They always have good sales. Right now they have like you can basically get 2 iPhones free if you purchase the 2 lines. So it's like $100 a month, deal plus 2 lines. Most phone companies charge $80 just for 1 line, so that's a good deal right there. Definitely something I'm going to continue to swing trading, as the fundamentals and the balance sheets look great for T-Mobile. And like I said, they're steady expanding. The 5G is going to be a great big revenue boost for 2021 for T-Mobile and a lot of other companies. So that was my 10 picks for quarter 2021. And the last thing we have here is ADP. It's up 5% today. I have a long-term position at ADP, so it's nice to see those gains. I appreciate you guys tuning in and watching. If you like the video, hit the like button, subscribe, hit the bell. I just posted a video earlier of the 22 stock picks I purchased. Today I'll be purchasing 23 stock picks for tomorrow. If you want to follow me and follow my investment strategy, I do stock picks, I analyze stocks, I do post stock movements. I got 12 portfolios. I post all the gains and losses, all the deposits, all the withdrawals, 100% transparency in all 12 brokerages that I own. I appreciate you guys for tuning in. I'll catch you in the next one.